know every strategy for transitioning your farming operation to the next generation? Stay tuned. Hi, I'm Norman A. Hood, financial advisor and host of the Exit Plan Show. I interview America's top advisors to help business owners enjoy more freedom, grow companies faster, and retire someday on their own terms. Today's guest is Daryl Dunneman. He's an agricultural financial consultant and accountant with Bonnet and Dunneman, LLC, certified public accountants and consultants. Bonnet and Dunneman serve clients in 18 states and have offices in Bushnell, Illinois and Havana, Illinois. Daryl's a 1975 graduate of the University of Illinois and a nationally recognized expert in the areas of agricultural financial analysis, business succession planning, and agricultural estate and income tax management. He's the editor of the Farm and Ranch Tax Letter, a monthly agricultural tax publication, and writes a regular tax management column for Farm Journal. Daryl's contributed to columns in practically every major farm publication in the United States and is a regular speaker at a number of national agricultural business education venues. 85% of Bonnet and Dunneman's business is in agriculture. Today we're going to talk about farm operation transfers. Thanks for joining us, Daryl.
Good to be here, Norm.
And we're going to talk about different strategies. We're going to talk about fair versus equal treatment when you have some heirs who are active in the farming operation and some that aren't. And we're also going to talk about the difference of a sale versus a gift of farm assets to the next generation. So let's get started about strategies. What are some strategies that farmers can use to transfer to the next generation?
One of the major things we try to build on, Norm, is trying to cut out a future partner in that operation, which is basically our Internal Revenue Service or our local state finance tax education or tax groups. And so we, a lot of times, if there are family members in the business, we obviously want to take a look at gifting some of the operating assets perhaps to that second generation. And this will work whether we're talking about a farm business or a non-farm business. The concept is the same. And a lot of times what we like to see is kind of a two-tiered approach. Hopefully your operation is set up so that you have what we'd call a tenant side, or if we're talking like an auto parts store, that'd be the operating part of the company. And then we'd have real estate, which is a more illiquid asset, or say the buildings, if we're looking at that same auto parts store, in a separate operation, because basically one of the things that people need to recognize, even though we think of families being this great all-together type of a thing, we have a conflict among those who are in the business and the conflict who those who are not in the business. So if I'm farming and I'm running the operation, I want to eliminate debt as quick as I can. I might forego some of the cash payments, family living, to make sure that we get the business on a sound footing, whereas if it were my brother and sister involved in that operation, their goal is more to get current cash flow out of the business. So we've got a natural problem, if you will. And so part of the way to cure that, we like to see a two-tiered setup. So the family members who are in the business are in what we call the tenant or the operating side, and the rest of the individuals then make excellent landlords. But then the operating entity will pay rents to the land entity. And so that's one thing to start to kind of set up, because principle one is you do not want farming or operating members in the same business structure with the landlords or the non-farming. And so gifting works well, and that's where sometimes fair versus equal comes in. Everybody thinks I'm a bright boy, and I came up with this myself, but I really didn't. I take ideas that I learn from my clients basically and repackage them. I don't know if you know this or not, but there's never been except one original thought. All the rest of it's plagiarism. Mm-hmm. And so my opportunity about learning about fair versus equal was a gentleman of mine who's now been gone about 20 years, real bright guy, he just lost his wife. And we were going to his attorney's office to set up, redo his estate plan, kind of took with it. And so I said, what are we going to do today? And he looked at me and said, well, we're going to be fair. I knew he had 3 children, and so I said, oh, fair means 1/3, 1/3, 1/3. He says, no. He says, that would be equal, but that necessarily wouldn't be fair. And he recited his history of his operation. Basically, he said that if the operation is something that happened to him and his wife before the son came back, then 1/3, 1/3, 1/3 would have been appropriate. However, he recognized that, he said that, he started out with 800 acres, and now that son was back, he had over 2,000 acres, and other parts of the operation had grown. And he said, I wouldn't have made that expansion if I didn't, if my son hadn't come back. Well, he's a liar. He still bought the farm ground anyway. But he did recognize the fact that the son contributed to the operation. And he had a formula worked out, and we do this often, did the individual who came back sacrifice to come back? Could he have gotten a better source of income? And we kind of use that to calculate what he should end up with in the end. And taking that into account then, if he's going to need these operating assets, we would just as soon get it to him through a gift because he's going to get it anyway. If we sell it to him, then we're going to lose part of it to income tax. Now again, that assumes that you're in good enough financial position that you feel comfortable. Because I know one of the most embarrassing things that ever happened to me was actually involved a family member corporation of mine, and I went down to a local well-known attorney that I did a lot of work with, and the father was going to retire, enough land outside the entity. It was an S corporation setup. And so I just assumed in my back of my head that the equipment and stuff was probably worth, after we got rid of the grain, $300,000 or $400,000. So I just assumed the second member would be buying that, paying that over to his father. And I still remember sitting in the attorney's office, and the attorney looked over the financial statements, which we'd provided before, and to him. And the attorney looked up and looked at my client, who happened to be my cousin, and said, do you really need the money from this sale? And I thought, my goodness, he didn't, because he'd done a good job of saving, had a nice retirement plan, had real estate outside. So it was kind of a silly question, really, that I should have asked. And in the end, what we ended up doing then was we gave the corporation to the one individual. There was another individual still in the family. That individual, then we set aside a certain amount of property. And in this case, the family felt that fair and equal were one and the same. So basically, one of the biggest things that we try to do is to set up a situation where if we can do gifting, we keep more money in the family, but then we do consider the contributions of all the parties involved. And it still kind of gets down sometimes. You may feel stronger about one thing or the other when something to happen. The golden rule applies. Now the golden rule I'm talking about is a little one different than the biblical one, but it's you've got the gold, you get to make the rules. Mm-hmm. And so if you do something, you got to remember long term, if we're successful in the succession planning process, if we can see down on the earth after we're gone, we want to see those families still gathered around the same Christmas and Thanksgiving dinner tables. Money sometimes, as much as we try to keep things from happening, money does break up family. Money's often the root of evil. And so the more planning we can do, and then you've got an obligation. If you're the individual doing something and it's not quite equitable or somebody perceives it as unequitable, your responsibility is to explain it to them. You don't want to have them to go into the attorney's office at your estate settlement. We're all sitting in a semicircle. The attorney reads, your estate plan. One party comes out, appears to come out better than the other. Then it's kind of, so-and-so got close to dad and mom. And so they took part of my inheritance. So the biggest thing is to try to do gifting, equalize up with other assets. And so our example, the individual who got all the operating assets, if you wanted that to be fair versus equal, wanted it to be fair, you might end up having him own less of the real estate, which isn't a problem. There are ways through limited liability corporations and things like that that we can structure that. And the biggest thing, again, we also talked about those entities. Those entities are going to give us discounts. And so they allow us to go ahead and transfer assets not at full fair market value to the second generation, either the individuals who are in a real estate situation, they will get shares of real estate. Entities make it very easy to divide up. We can't give away 1 or 2 acres at a time. So if we have a favorite tool is a limited liability company, or some attorneys use trusts, family trusts to do those, we give away shares. They have to be valued. We calculate discounts, and then that gives us our assets. And again, with a discount, some people say, well, I don't know that I want to give away something. We'll stop and think, how much are you really giving away? $14,000 of land translates to back 1 or 2 acres. That's $300 or $400 per year or per acre. Not a big number. So look at entities, do your planning, determine in your own family what you feel to be fair versus equal, and then make sure it's drafted and put on paper with a competent attorney.
Huh, great. I think we covered it. Different ways to transfer your farming operation to the next generation, whether that be your family members, I guess could be your key employees. How to determine and fair versus equal, and advantages of sales versus gifts. So if you want more information from Daryl, you can visit our website. Watch this episode. Down below you'll see the show notes, all the information about him, all these contact information. And you can also visit our website for other episodes and join us again for the next one. Thanks.